Good morning, candidates. This is regarding ratio analysis. We must have seen a lot of ratio analysis notes, but this has been presented in, say, one of the presented by Institute of Chartered Accountants. So I think it will be more useful for us. Yeah. Now let us go through this. Why it is not coming? It's not coming fully. I am not able to see it. It's not coming fully. Yeah, I think. Yeah, ratio analysis. It is ratio means it indicates the quotient of two mathematical expressions or relationship between two or more things, signifying a plausible relationship. There can be a relationship between these two. What is ratio analysis? Comparison of ratios against previous periods and with those of other companies. Then objectives, stakeholders can draw conclusion with respect to performance of the company, strength and weaknesses of the company, decision making. Caution, a single ratio can be meaningless in itself, and one needs to know the components of numerator and denominator. The types of ratios, the types of ratios is say liquidity ratio, leverage ratio, activity ratio, then profitability ratio. Leverage ratio, you have capital structure ratios, then coverage ratios, then profitability ratio, you have related to sales, related to overall return of investment, that is assets or capital employed or equity, are required for analysis from owner's point of view, related to market valuation, then investors from the angle of investors. Liquidity or short-term insolvency means the ability of the business to pay its short-term liabilities. Inability to pay off short-term liabilities affects the credibility of the company and hence credit rating. Various liquidity ratios are 1. Current ratio, B. Quick ratio or acid test ratio, 3. Cash ratio or absolute liquidity ratio, D. Basic defense interval or interval measure ratios, then E. Networking capital ratios. Normally in banks, we go through the first two, current ratio and quick ratio or acid test ratio. Current ratio is equal to current assets by current liabilities. Most common ratio for short-term solvency with 2 is to 1 as acceptable ratio, but can vary. But in banks, normally we say 1.33 is to 1. Current assets is equal to inventory plus sundry debtor plus cash and bank balances plus receivables plus loans and advances plus disposable investments plus prepaid expenses. Current liabilities is equal to creditors for goods and services, short-term loans, bank overdraft, cash credit, outstanding expenses, provision for taxation, proposed dividend, unclaimed dividend. Then quick ratio or acid test ratio is equal to quick assets by current liabilities. More conservative measure of short-term liquidity. That is, if all sales revenue should disappear, would my business meet its current obligations? Quick assets means current assets minus inventories minus prepaid expenses. Then next, net working capital ratio is equal to current assets minus current liabilities. These three are important. Then other liquidity ratio, cash ratio, please go through this. Normally in banks, we don't go for this, but maybe they have told this in Exim Bank. Please go through this. People going for NIACL also, please go through this. Leverage ratios, capital structure ratios, equity ratio, shareholders' equity versus net assets. It indicates proportion of owners' funds to total invested in the business. Debt ratio, total debt by net assets. Debt to equity, total debt to shareholders' equity. It's an indicator of financial leverage. Higher the ratio or greater is or less the protection for creditors. That is total debt. That is, if the debt is more, less protection for shareholders. Debt to total assets, total debt by total assets, higher ratio means higher leverage. No, it is reversible. Total debt by total assets. If the total debts is higher, it means it's a negative point. Capital gearing. Please go through this. Proprietary ratio. Then coverage ratio, debt service coverage ratio, important one in the case of banks giving term loans. Earnings available for debt service divided by interest plus installments. Nice, they have given it very well. Ability to pay off current interest and installments. Good. Earning available for debt service, net profit, earnings before taxes plus non-cash operating expenses like depreciation and other amortizations plus interest plus other adjustments like loss on sale of fixed assets or cash from operations before tax. Debt service coverage ratio, important one. Interest coverage, EBIT, earnings before income tax divided by interest. So these are important one. Please go through the other ratios also. Next one, total assets turnover, sales divided by total assets. Fixed assets turnover, sales by fixed assets. Capital turnover, sales by total assets minus total current liabilities. Current assets turnover, sales by current assets, but these are normally not checked up in the case of banks loans, but still let us be knowing this. Receivables, credit sales by average receivables, inventory sales by average inventory, receivables 12 months or 52 weeks or 360 days by RT ratio, then payable turnover, credit purchases by average accounts payable. Then profitability ratio, gross profit ratio, gross profit by sales into 100. This ratio tells us something about the business ability consistently to control its production costs or to manage the margins it makes on products it buys and sells. Net profit ratio, net profit by sales into 100. Operating profit ratio, operating profit by sales into 100. Operating profit is equal to earning before income tax. Expenses ratio, cost of goods sold divided by sales into 100. Operating expenses, administrative expenses plus selling plus distribution divided by assets into 100. Operating ratio, COGS, cost of goods sold plus operating expenses by sales into 100. Then financial expenses ratio, financial expenses by sales into 100. It measures the portion of a particular expenses in comparison to sales. Yeah. Then profitability ratios, a return on investment. 1 minute. Let me give this link for this candidate. If he wants, let him come. Return on investment, return or profit by earnings divided by investments rendered. It measures overall return of the business on investment, return on assets, net profit. Yeah, return on investment, then return on assets. These are important. Then return on capital employed, EBIT by capital employed into 100. When assets are also financed by lenders, then a return on assets is equal to EBIT minus T or NP plus interest divided by average total asset. Please try to understand. Return on equity or DuPont model. Please go through these things. This is coming in a new way. Please go through this. Please read it carefully. Try to understand. This has been prepared by Chartered Accountant Institute. So it may be slightly difficult, but still go through this once, twice, thrice to know it. Then other profitability ratio, price earning ratio, MPS by EPS indicates the payback period to the investors or prospective investors, higher ratio, growth expected or stock overvalued, dividends yield, earnings yield. These are all not very much important, but still go through. Users and objective of financial analysis, how shareholders are using it. Being owners of the organization, they are interested to know about profitability. So please go through this. Then investors, they are interested to know overall financial health. Then lenders, then creditors, both are same. Then employees, regulator or government. Users and objective financial analysis, production managers, sales managers, financial managers, different industry, telecom, bank, hotel, transport. It will be compared with other similar companies. In the case of telecom, ratio related to call revenue and expenses per customer. In the case of banks, loan to deposit ratio, and then operating expenses income ratio. 1 minute, just a minute. Let me check up. Yeah, in the case of hotel, room occupancy ratio, transport, I think they depending on usage. Yeah. Then test yourself. So you may have to work out this and check up. Observing changes in the financial variables across the years is horizontal analysis. Then a company has a net profit margin of 5%, total assets 90 lakhs, and return on assets at 9%. Its total asset turnover ratio would be 5%. Nisha, you are going for Exim Bank?
Yes, sir.
Nisha? Yeah, yeah. I have
Yes,
just
sir.
now
Yes, sir.
covered. I have just now covered this material that as I have given you already. I hope you have gone through this
Sir, I
ratio.
checked in Drive, but this PDF I didn't get.
No, no, I have given it now in your Exim Bank um, folder
Drive.
itself. Folder itself.
Okay, I'll check, sir, then.
So this is actually very good one because it has been brought out by our Chartered Accountant Institute, and it seems they have used this for coaching our candidates. Okay, 1 minute.
Okay.
Haripriya, Purnima phone பண்ற பூர்ணிமா அம்மாட்ட சொல்லியிருக்கேன் அம்மா எடுக்கிற போன். Yeah. So this is what it is. So this is the very important material. I request you to go through this. And yeah, here we are here. So apart from this, what is most important is I have given you exam job interview questions and answers. Have you gone through this,
Still, I
Nisha?
didn't get time to, sir, to go
What
through
is
these questions.
why? When did you join us?
On Monday.
Only Monday means 5 days over. Still, you couldn't get time.
Actually, sir, I'm working.
Yeah, yeah. You are working somewhere. Acha, you are working in which
Yes.
company?
In SR Battleboy and Associates.
Acha, what are you there? Acha, 1 minute. I am recording it. I'll stop it. Hmm.